Working capital components. In the first 3 lessons of this course, we've been very high level, looking at financial reporting from a top-down perspective. In this session, we're going to start getting detailed, and we're going to look at working capital's key components, what they comprise, and how they're accounted for. We will look at how items in working capital on either side of the balance sheet are linked through common business transactions and illustrate the relationships with simple examples. We will look at bad debts and how they are accounted for and reported. Session aims. In this session, you will learn about working capital's key components, what they comprise and how they're accounted for. We will look at items in working capital on either side of the balance sheet that are linked through common business transactions and illustrate the relationships with simple examples. We will look at bad debts and how they're accounted for and reported. And as usual, intended learning outcomes for this lesson. So, working capital. We've talked about working capital quite a lot. Working capital concerns the trading assets and liabilities of the firm. And we can define working capital as current assets minus current liabilities. And we've looked at this graphically. There's no reason that current assets should be greater than current liabilities, but if it is, then we define working capital as net current assets. If current liabilities are greater than current assets, then we define it as net current liabilities. I think it's helpful to look at the components of working capital together because they are managed as a whole and because various key items on each side are linked by common business transactions. But we'll start with one item that we should be familiar with, which does not have a linked item on the liability side, and that is inventory. Inventory comprises raw materials, work in progress, and finished goods, also referred to as stock. The first pair of linked items are accounts receivable as a current assets and accounts payable as a current liability. The sale of goods on credit results in matching entries in one firm's accounts receivable and in its customer's accounts payable. The second pair of linked accounts are prepaid expenses and unearned income. Payment for goods and services in advance results in the firm making the payment, recording the value of the payment in prepayments or prepaid expenses, and the firm receiving the payment, recording its corresponding liability as unearned income. Our next pair of linked items are accrued income and accrued expenses. Paying for goods or services in arrears requires the firm consuming the service to record the cost of the services used in accrued expenses. The firm providing the service can recognize the revenue from providing the service and record the amount owed in accrued income. These tend to be estimated and they have not yet been invoiced for. And our last pair of related items are cash and cash equivalents and overdrafts and short-term financing. A company that holds a lot of cash and cash equivalents will tend to have no overdrafts or short-term financing. And likewise, if a firm requires an overdraft or short-term financing, it will keep the amount of cash that it has as low as possible. And finally, we've got 2 items on the current liabilities side which do not have corresponding items on current assets. So the current portion of any long-term debt, so this is principal or interest on long-term debt that is payable within the next 12 months, and any tax and other payables which are due for payment within the next 12 months. Inventory comprises goods to be traded, to be processed as finished goods and sold, or to be used up in the day-to-day operations of a firm. Inventory is sometimes referred to as stock. It may be classified and reported as raw materials, work in progress, or finished goods. The accounting treatment of inventory depends on whether it is comprised of identifiable or indistinguishable goods. Identifiable goods comprise products where each item is unique and can be separately identified, for example, by a serial or a batch number. Indistinguishable comprise products where individual items cannot be told apart. We'll start with identifiable inventory. So an example of a car on a production line, so individual items can be tracked and identified with serial or batch numbers. And this accounts for some raw materials, most work in progress, and most finished goods. And the accounting treatment for inventory in terms of its valuation, the amount that is held on the balance sheet, that is reported on the statement of financial position, is based on full historic costs. So the value of each item reflects the cost of raw materials and also the cost of direct labour that have been expended in the processing or the production of the goods, and finally a share of the manufacturing overheads from the factory in which or manufacturing facility in which the goods were produced. Indistinguishable inventory is quite different. Indistinguishable inventory comprises of individual items that cannot be told apart. And examples of this are common commodities, industrial commodities such as oil, gas, coal, steel, copper, and some agricultural produce. The accounting treatment for this, there are three possible ways in which inventory can be valued from an accounting perspective. It can be valued on the basis of the most recent prices that have been paid for the inventory. It can be based on the oldest prices that have been paid, or it can be based on an average cost. And all three methods are possible, and we will look at these in due course. A really important equation is the inventory valuation equation, and we will see this equation in one form or another throughout this course. So the value of inventory at the end of the period is given by the value at the start of the period plus the value of new additions to the inventory minus the cost of goods sold from the inventory. And this equation applies to both types of inventory. So the value at the end of the period equals value at the start plus additions minus cost of goods sold from inventory. Firms transact most of their business with one another on credit, typically 30 to 60 days. Accounts receivables and accounts payable are opposite sides of the same business transaction, the sale of goods or services from or by a supplier to a customer on credit terms. On the supplier side, we have accounts receivable gross. This account is used to record invoices issued by the company to its customers for goods and services it has sold to them on credit. It represents amounts owed to the firm due for payment within 12 months and is hence a current asset. Sales must meet IFRS revenue recognition rules to be recorded here, which we will look at in due course. Accounts receivable bears credit risk. This is the risk that customers will not pay everything they owe, resulting in bad debts. This shows the contractual amount owed to the firm and can be found in the notes to the account. On the customer side, we have accounts payable. This account is used to record unpaid invoices received by the company from its suppliers for goods it has bought or services it has used. It represents amounts that the firm owes its suppliers due for payment within 12 months. This is the other side to the matching item from a sale on credit recorded in another firm's accounts receivable. Accounts payable represents free financing that suppliers give customers in order to help win sales. The value of accounts payable is reported in the statement of financial position. And just as we had an inventory equation, we can also look at the movements in the accounts receivable gross account. So the value for accounts receivable at the end of the period is equal to the value at the start of the period plus new invoices issued to its customers during the period minus payment received from customers for outstanding invoices minus invoices from bad debts written off. And the accounts payable, the value for accounts payable at the end of the period is equal to the value at the start plus new invoices received from suppliers during the period minus payments made to suppliers for invoices received and paid during the period. So we have accounts receivable gross. This is before bad debts. Not every invoice will be paid. And there is a need for what is called an impairment allowance. And the impairment allowance is used to record the value of expected losses on bad debts. So the value that is reported in the impairment allowance is the difference between the value of outstanding invoices issued and the amount management actually expects to get back after bad debts. It is also colloquially known as bad debt allowances. So this is a contra item. This is a negative amount. The accounts receivable gross and the impairment allowance are both shown in the notes. What appears on the statement of financial position is accounts receivable net of impairment allowances. And this is the value of outstanding invoices that the company expects to actually receive after bad debt losses. So in the statement of financial position, we see accounts receivable net of impairment allowances. And that's changes in the impairment allowances are created by charges for bad debts taken through in the period in which those bad debts were identified. So let's look at an example of a credit sale. Sale of goods by a Chinese company, Lee Limited, to Smith & Easton. So on the 21st, Smith & Easton ordered goods at a total price of 84,000 yuan, Chinese renminbi, from Lee Limited for delivery on 3rd of June. They agreed credit terms of 60 days. On 30th of June, Lee Limited delivered the goods to Smith Easton and presented them with an invoice for 84,000 yuan and a due date of 2nd of August. So, nothing happens on the 21st of May other than recognizing that the order has been placed. In terms of the financial records, on the 3rd of June, at the time that the delivery of the goods to Smith & Easton has been made, Lee Limited can recognize revenue of 84,000 yuan from the sale through the income statement, which will have the effect of increasing equity in the month of June. It records the 84,000 the firm is owed for the goods in accounts receivable. On the same day, Smith & Easton, on delivery, will record the goods in inventory at their purchase cost of 84,000 yuan in the statement of financial position, and they will also record the same amount, 84,000 yuan, owed to Lee Limited for the goods in accounts payable. On the 2nd, so same example, on the 2nd of August, Smith & Easton paid the 84,000 yuan owed for the goods to Lee Limited. So at Smith & Easton, when they pay the bill, the invoice, cash and cash equivalents will be reduced by 84,000 payment made to Lee Limited. The invoice and accounts payable from Lee Limited is marked as paid and the outstanding balance reduced to 0. At Lee Limited, the cash and cash equivalents at Lee Limited are increased by the 84,000 yuan payment received from Smith & Easton. The invoice and accounts receivable is marked as paid and the outstanding balance reduced to 0. So let's look at revenues, cash receipts, and accounts receivable across a year. So a reminder, the accounts receivable at the end of the year is equal to accounts receivable at the start of the year, plus new invoices raised, which is revenue recognized from credit sales, minus payment from customers for credit sales, minus invoices written off. So we're going to look at Bosch Limited, started the year with 64,200 euros in the accounts receivable at the end of 2018. It recorded revenues of 220,000 euros 800 for 2019 and received payments of 192,500 euros from customers, and all of these are done on credit terms. And there were no bad debts or write-offs, so the value in the accounts receivable at the end of the year is equal to the value at the start, 64,200, plus new invoices raised, which is 220,800 euro, minus the amount which has been received from customers by on credit, which is 192,500 euro, giving us 92,500 euros at the end of the year. So the second example, this time an example of treatment of sale on credit with bad debt and impairment allowances. So Lee Limited again, this time sale of goods to Bourne PLC. On 29th of May, Bourne ordered goods for $150,000 from Lee for delivery on 21st of June and have asked for 90 days credit, payment due on 21st of September. Lee's credit control department are worried about Bourne's creditworthiness, but Lee Limited CEO is very keen to proceed, as it is a large order and they've got a very good price and authorises the sale on these terms. On 21st of June, Lee delivered the goods to Bourne PLC and presented them with an invoice for $150,000 with a due date of 21st of September. So the accounting is as before, just different values. So on Lee Limited, goods delivered to Bourne PLC, Lee recognises $150,000 in revenue and records the amount owed from Bourne in accounts receivable. And on the other side, Bourne records the goods in inventory for $150,000 and records the amount that Bourne owed to Lee in accounts payable. So let's move on to the next part, which is an impairment event occurs. On 2nd of August, Lee Limited is informed that Bourne has defaulted on a loan from its bank and is not expected to be able to pay all of its creditors. Lee Limited is now advised that it is now only likely to get back $30,000 of the $150,000 it is owed. This is a bad debt loss of $120,000. So, how do we account for this? So, on the 2nd of August, at the time that this news is received, Lee takes a charge for the expected loss, which is $120,000, the difference between the $150,000 invoice and the $30,000 now expects to get back, through the income statement to recognise the bad debt loss. This creates an impairment allowance for $120,000, the difference between the contractual amount due and that now expected. And accounts receivable is reported in the statement of financial position net of allowances and now reflects the expected recovery value of $30,000. There will be no changes on the accounts payable side for Bourne, although that will all come under the control of the administrators in due course. The amount which is in the gross accounts receivable, the invoice amount will remain there. It is the contractual amount, but the amount that's reported in the statement of financial position is what they actually expect to get back. Prepaid expenses or prepayments and deferred or unearned income are opposite sides of the same business transaction. Payment made in advance by a customer to a supplier for services to be delivered at a future time. Paying suppliers for their services or products in advance creates a liability as unearned or deferred income at the supplier and is recorded as an asset by the customer. Most prepayments are for services or products which will be delivered within the next 12 months and are therefore recorded as current assets and as current liabilities. And probably one of the most common examples or day-to-day examples of a prepaid expense or a prepayment is an airline ticket, where the customer buys the ticket in advance. From the point of view of the customer, an airline ticket represents a prepayment, while from the point of view of the airline, which has received the cash for the ticket but has not yet delivered the service, that cash received is on the asset side of the balance sheet. A corresponding amount is recognised as unearned income, as a liability, and this will be removed when the flight is actually taken and the service is delivered. So cost of services or products, so on the balance sheet, the total will be the cost of services or products that have been paid for in advance and will be used within 12 months. And for the supplier, the value of cash received for services or products that the firm will deliver within the next, or has promised to deliver within the next 12 months. Accrued income and accrued expenses are opposite sides of the same business transaction. Services that have been consumed by customers and are invoiced in arrears. Consuming services before they are invoiced creates current liabilities at customers and current assets at the suppliers. The most easily recognisable of these are utility bills such as electricity or gas, where the firm can read its meter and see how much it has actually consumed during a period but has not yet been invoiced for. So it can estimate the cost of its usage, and that value of the cost per period that's been used up is recognised in accrued expenses, and typically this is for electricity, gas, water, property taxes and security services, all things that are consumed and invoiced in arrears. When the invoices are received, the outstanding balance in accrued expenses is effectively transferred to accounts payable. On the other side, at the supplier, provided the supplier can estimate realistically the amount of income that has been earned but has not yet been invoiced, this amount can be recognized as income, and the value which has been recognized but not yet invoiced for is recorded in accrued income. When the invoice is actually raised and sent to the customer, the outstanding balance in accrued income is transferred effectively to the accounts receivable. So, accrued income that the firm has earned but has not yet been invoiced. This income is recognised as revenue in the income statement of the period in which it's earned. Accrued income represents the amount that's owed to the firm payable within 12 months. And accrued expenses at the customer, expenses that a firm has incurred but have not yet been invoiced for. The expenses are recognised in the income statements in the period in which they are incurred. Accrued expenses represents amounts that are owed to a firm's suppliers and are payable within 12 months. And when the invoices are raised, the balances outstanding in accrued income and expenses are transferred to accounts receivable and accounts payable. So, an example of accrued income. A firm has a contract to collect used cooking oil from restaurants on a monthly basis. It invoices its customers every 6 months for £600 payable in arrears, so £100 a month. Each month, it recognises £100 in income from each customer, with the balance owed by the customer recorded in accrued income. At the end of the 6th month, it transfers the £500 balance from accrued income to accounts payable, plus the £100 earned for the 6th month, and issues an invoice to the customer for £600. And an example of accrued expense: a firm is invoiced for electricity every 3 months. It is able to estimate the cost of what it uses each month. These costs are expensed on a monthly basis, and the estimated balance outstanding is recorded in accrued expenses. When the invoice is received, the balance outstanding in accrued expenses is transferred to accounts payable. So let's take an example of accrued income and expenses across a year. Strong and Stable provides security services to Snow for £12,000 a quarter, invoiced for and paid in arrears on 10-day payment terms. Both firms have financial year end of 31st of December 2018. Contract runs from 1st of March 2018 to 28th of February 2019. So let's look at the financial statements for the year ended 31st of December 2018. So there are 10 months of this contract in the current financial year. So 1st of March through to 31st of December is 10 months. So income of £4,000 a month times 10 months, income of £40,000 for the year. There have been 3 quarterly payments, each totaling 36,000, and those cover the March, April, May, June, July, August, and September, October, November periods. And £4,000 is owing for December, and that is recorded at Strong and Stable as accrued income. And Snow plc recognise expenses for security services for £40,000 for the year. £36,000 has been paid, and the remaining £4,000 is recorded and taken through the income statement as accrued expenses. Cash and cash equivalents. These are related from a business perspective. It is not a good idea for companies to keep a lot of cash. Investors want firms to invest in productive assets, not hold up large amounts of cash. Cash generates small returns, low returns, and investors can manage their own cash without. They don't want firms to do that. They want firms to invest in productive assets. So firms try to keep the amount of cash to a minimum, and we'll look at cash and working capital requirements separately. They need to keep enough cash to meet their liquidity requirements, but no more. A company that has a lot of cash has no reason to take out an expensive short-term overdraft from a bank. On the other hand, if a firm does need to take an overdraft from a bank, it's because it has no cash to meet its liquidity requirements. So we will typically see, if we see a large amount of cash, we will not see an overdraft, and if we see an overdraft, we will tend not to expect to see any cash. So companies generally try not to hold too much cash. Investors want firms to invest their invested funds in operating assets, not cash, and they hold just enough to meet cash management liquidity requirements. And on the liability side, short-term borrowing is expensive and may not always be relied on, although it may be used by firms as seasonal cash flows rather than holding large amounts of cash through this cycle. So the complementary items, if the value of one is high, the value of the other is usually either zero or very low. Other components of working capital and current liabilities, so tax payable. Tax payable is used to record the value of corporation or income tax payable in the next 12 months. And there may also be the current portion of long-term debt. So this is debt. So two parts to it: interest payments on long-term loans and coupon payments on bonds that are payable in the next 12 months. So the interest payment portion, and also the outstanding balance of any long-term loans that are due to be paid off in the next 12 months, and the principal of bonds issued that are due to mature during that period will also appear under current liabilities. And here we have a breakdown of Morrison's working capital for 2017. So reported in the notes and what's actually reported in the statement of financial position. So cash and cash equivalents of £326 million. Accounts receivable, so 143 gross. Impairment allowance of 6 million. So net of impairment allowance 137 million. Inventory of 640 million pounds. Prepaid expenses 68 million. Other current assets, which in fact comprises the value of some derivatives. And then, so current assets is on the balance sheet is 1176 million, and on the liability side, this very large number for supplier credit accounts payable 2837, and we'll revisit accounts payable. But this reflects the strength of the power of where the power and the relationship between the big supermarkets, who are small in number, and their suppliers, who are large in number and have no choice other than to deal with the supermarket. This large number reflects the power, the negotiating power of the supermarkets. We see that overdrafts and other financial liabilities is a very small number, which is not surprising given the large cash figure and some current tax liabilities. And if we were to take the net asset presentation form, not quite sure why. So we've looked at working capital's key components, what they comprise and how they're accounted for, how items in working capital on either side of the balance sheet are linked through common business transactions, and illustrated the relationship with simple examples. And finally, we've looked at bad debts and how they're accounted for and reported.